Research. Welcome to our Inner Circle weekly webinar. It's Monday, the 13th of October, just after 4:15 Eastern for the benefit of the tape. We have a very special session today in the light of the events in the crypto market. On Friday of the weekend, we've thrown this webinar open to all comers. So we have many people with us. Welcome everyone if you're not a member of the Inner Circle service, and indeed if you are. We're going to spend the first section of this webinar talking about crypto, just run through the events of Friday, what I think this means, and frankly, how to profit from it, in my opinion. We'll move on from that and talk about the equity indices, which also took a hit, of course, from Friday, and see where we stand on that. As always, we run these things on a live and open mic basis. So once we've done disclaimer in a moment, I'll open mics and people can lob questions, points, comments, anything at all. By doing so, just open your mic and shout into the system. Alternatively, you can use the comments or the Q&A function here in the webinar platform. If you are new to this service, just a couple of house rules. We run on very simple lines. Number one, keep it clean. It's a family show. Number two, we don't discuss any personal politics whatsoever. Of course, politics affects markets. Markets affect politics. Of course it does, but no one cares about your own personal opinions about politics, so please leave them at the door. And thirdly, no such thing as a stupid question. So these webinars are valuable to the extent they become discussions rather than lectures. So if you have any questions, points, comments, anything, even if you think it's a dumb question, I guarantee you it isn't. It's probably a great question. So do lob it over. Again, either use audio by shouting into the system or use the text functions in the webinar software. Okay, I'm going to read our disclaimer in a moment, and then we'll switch mics on and we will get going. This webinar, by the way, is being recorded and we'll distribute it afterwards in the usual platforms. Okay, so disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestern Capital Research. Cestern Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, let's get mics on. Okay, mics are on. Okay, so what happened on Friday? What happened on Friday was, by some estimates, about $19 billion of value in crypto positions were wiped out. Why is that? Well, history will get it in detail, but some combination of unexpected volatility in the equity markets bleeding over into crypto, some glitches, let's say, in how some of the crypto exchanges worked, some glitches in how some of the stable coins worked. But overall, why did it happen? Because of the colossal amount of leverage in crypto exchanges. So in equities, large hedge funds who control risk on a minute-by-minute basis will run 6, maybe 7 times leverage. Individuals might run 1 or 2 times leverage on their accounts. They might own some 3 times levered index ETFs or sector ETFs, that sort of thing. We're talking low single digits of leverage here, even for the world's most sophisticated investors. If you look at, let's say, Renaissance Technologies, probably the most successful hedge fund around, entirely quantitative in nature, millions of dollars worth of analyst resource, millions of dollars worth of compute resource to measure risk, 6 times leverage on average. Crypto positions were being held at 5, 10, 20, up to 50 times leverage. And so obviously not by investors with the degree of risk control that Renaissance Technologies have. So unsurprisingly, when the market hit a bump, so too did a large number of these levered positions. Now, the human consequences of that have been pretty terrible. We've all seen stories of people taking their own lives according to the losses they've suffered, which is dreadful, and it's tragedy. There's nothing else that anyone can say about it. But systemically, this is what happens when markets get too levered. and big shocks come along. The interesting thing about it was that most of the losses were in the altcoins. So by altcoins, what I mean is anything other than Bitcoin and Ether. And I appreciate that is a relatively controversial definition. If you are a crypto native and you trade some of the bigger names like Solana, Ripple, so on and so forth, you'll have a view about that. But as I'm going to explain in a moment, for a few months now, and absolutely going forward, in my opinion, the only two crypto tokens, coins that matter are Bitcoin and Ether, and the rest are, gambling side projects. And then arguments are only going to get stronger as time goes by. So again, by some estimates, and these numbers are unconfirmed, it will take time to firm up, but by some estimates, about 25% of that liquidated value hit the combined Bitcoin and Ether, and about 75% hit the very large long tail of altcoins. How to profit from this? Okay, if you trade crypto, and in particular, if you trade crypto in its native form as opposed to ETFs, if you use the actual crypto environment, crypto exchanges, you swap your dollars for stable coins to get on there, you swap your stable coins for individual cryptocurrencies. If you survive this in my opinion is a wake-up call. It's a shot across the bows. It tells you that the dream, as promulgated by most of Twitter in the last 5-6 years, the dream of an alternative financial system, that in my opinion is gone. But it didn't die, it was bought out. It was acquired by Wall Street. Two coins, in my opinion, have a genuine shot at longevity, and they're Bitcoin and Ether. Why is that? And the answer is because they have actual, genuine, wide-scale utility. Let's go through that for a minute. So Bitcoin, what is its utility? Well, as everyone is proud of saying, number one utility is crime, and there is some truth to that. Store of value, I don't know, it's a very volatile thing, but as a way to transfer capital in and out of countries that don't have stable banking systems, where it's difficult to access the US dollar system, then sure, it has some value there. And as a way to invest kind of in a commodity which is upon limited supply, which will tend to go up over time, sure, I can understand that too. And of course, as a pure financial asset to trade, to gamble, then it has that too. Ether, slightly different. Ether's supply is not as tightly controlled as Bitcoin. It is controlled by consensus rather than by definition and algorithm, but it has some control over it. Why Ether has value is because Wall Street has decided that the digitization, the tokenization of real world assets is going to be a thing. What does that mean? It means that Wall Street is creating digital twins of assets in the real world that include buildings, pieces of art, cars, even stocks. And what's the reason to do that? The reason to do it is because that way you can reach what Wall Street would call new sources of liquidity, which the rest of us would call new pockets of money that Wall Street can't reach yet. So for instance, if you run a private credit fund, then you might be finding life a little bit difficult at the moment because you probably tapped out all of the pension funds and insurance companies that were ever likely to invest in private credit. But what you haven't tapped out is retail. Now, right now, retail in the conventional financial system can't invest in your fund. It's defined as such. But if you create a digital twin of your fund or digitized tokens that can access your fund, then you can sell it according to new financial legislation in the US. You can sell it into people's 401ks and other sources of capital. So it's a way to find new buyers, new providers of money. And the other way to do it is increased transaction velocity and probably less regulation. So it is probable, not definite, but probable that whatever shenanigans were going on in the crypto market this weekend, it probably wasn't securities fraud. It probably wasn't insider anything, even if there was a bit of that. because famously, crypto is not a security. If it's anything, it's a commodity. And so this tokenization of assets has a shot, I think, at being a bit less regulated than the securities market. And that's great if you're an asset owner. It's great if you are a broker. It's great if you are a liquidity provider. It's great for everybody in the plumbing. And so the dawn of the Ether treasury companies, your Bitmine Immersion, Sharplink Gaming, all of this, this is a reaction to the fact that Ether is now de facto currency of tokenization. Wall Street's chosen the Ethereum blockchain database to do this on because, again, it has utility. It can handle posting of collateral. It can handle yield, and it can handle relatively complex contracts, you then referred to as smart contracts in the Ethereum world, that define different aspects of a tokenized asset, rights and obligations according to it, and so on and so forth. So Ether has become a real thing with real utility. To play crypto now, in my opinion, if you want to win at crypto, you have to play by Wall Street rules, because Wall Street just took it over. This is a really important slide. It looks like a boring slide, but it isn't. If you want evidence of the fact that Wall Street now owns crypto, this is a chart of Ether going back to the COVID lows, and the numbers on it don't matter so much, but let me walk you through it. Here's the COVID lows, and you've got Ether worth, let me zoom in so I can actually see it, around $113 down here. And we get this huge run up to the 2021 bull market high at 48.50 or thereabouts. Okay, nothing particularly Wall Streety about that. That's just an asset racing away. But look what happens next. The bear market hits. Now, in bear markets in high beta stocks, your Nvidias, Metas, all those sorts of things, then you can measure and predict to a degree the degree of sell-offs. Okay, so very roughly after a big move up like that, you'll see an Nvidia or a Meta or any of the other big tech names in a really, really, really brutal bear move. They'll drop to something called the 78.6 retracement. These are Fibonacci levels for those of you who are familiar. And of course, this is not definite, programmatic. It's not certainty, but more often than is coincidence, you'll see high beta stocks pause at key Fibonacci levels on the way down. The 61.8 retrace is important. That's this level here in Ether. This was around, let me see, 1900. And then in a really deep bear market, as I say, the 78.6 retrace comes into play, which was just around, if I remember, 1200, 1300, something like that. And you can see round here towards the middle of 2022, Ether bottomed out here. And that's a tell. That's a giant tell that says that this is Wall Street at work. This is big money at work. Ether then starts this next move up. In our technical analysis system, Elliott wave, you call this a wave 3. But what it really means is it's formed a low down here, and then volume starts to spike. These gray bars on here, the horizontal bars, these are volume by price bars. This tells you how much volume is being traded at any particular price area. This is volume by time down here. This is volume by day or week, depending on how you set the chart up. This is volume by price, and it tells you an awful lot. So if you recall, in 2022 and early 23, no one had a good word to say about crypto, particularly about Ether. Right? It was a one-trick pony. It was gone. No one was interested. If crypto had a future at all, it was Bitcoin. You remember that time. But look, all the while that screamingly negative narrative was everywhere. Volume was spiking. Look, so volume in this price range here picks up colossally. So that is another tell. That tells you that this is Wall Street buying. Now, this stops at around September 23, so 2 years ago. There is absolutely no possibility that the changes in tokenization and the institutional adoption of Ether now were not in train 2 years ago. These things take 3, 4, 5 years to do. So it was well known within big money circles, or it was deemed highly probable within big money circles that Ether would become something of great utility, which is why you see this big volume accumulation down here. And then it's also why you see this terrific volatility as it starts to move up. Why is this? This is to destroy levered positions unconfident holders, tourists, all that. Volatility is there for a reason. First of all, highly volatile assets, when they trend up, tend to move up a lot. So the flip side of volatility is often, always, often great returns. But the purpose of volatility here is shakeout. Right? Get rid of, in crypto world, you call it paper hands. In any other world, you just say tourists, or in particular, levered positions. So the shakeout that just happened, the magnitude of it was probably a surprise to a lot of people, but that a shakeout of levered positions was due, it's probably not a controversial thing to say. So this price action, this volume action, tells you that Ether, and you could show something similar for Bitcoin. I don't have a chart prepared, but it would show you something broadly similar. This tells you this is the breadcrumb trail of big money. Okay, this is not crypto enthusiasts. This is not people building an alternative financial system. This is not, the way to freedom from fiat money or any of that nonsense that you see all over Twitter. This is Wall Street. This is exactly what Wall Street does with high beta securities, and it's exactly what's happening with Ether. Next, so if you want to win at crypto now, what to do? Well, my opinion is very simple, which is just follow big money. The best thing that one can ever do, in my opinion, in public market finance, investing and trading, is don't try and be innovative. Don't try and get ahead of the steamroller. Why would you? It'll crush you. Just get a little bit behind it. So work out what big money is doing. You don't even need to know why. All you need is price and volume. Who cares why it's happening? And follow them. And so, why I said earlier, if you traded native crypto and you survived, this is a wake-up call, is because this is the state of crypto now, in my opinion. Nobody cares about your altcoin position. Nobody cares about crypto exchanges. But the whole of Wall Street cares about, for instance, the big BlackRock crypto ETFs, IBIT on the Bitcoin side and ETHA on the Ether side. And of course, there are a long list of other Bitcoin and Ether ETFs, but these are the big ones. And BlackRock is obviously the big dog. If you have levered positions in small cap coins and they're destroyed, if your position is destroyed or the coin itself is destroyed, no one cares. That's your problem. But if these two ETFs are destroyed, it's Larry Fink's problem. Larry Fink, CEO of BlackRock. It's Wall Street's problem. So, as the famous saying goes, if you owe the bank a small amount of money, it's your problem. If you owe the bank an enormous amount of money, it's the bank's problem. And so the equivalent in crypto is, if you are in IBIT or ETHA, then they are highly unlikely to be destroyed. Why? Because Wall Street has invested big in these things. And so for me, I own these two ETFs. I don't own any native crypto, never have, never will. Never want the exchange risk, never want the counterparty risk. I'm old and I've watched this since the days of Mt. Gox, and periodically, the big frauds, they're always in crypto exchanges or brokerage or something else. And you can't predict them, but they pop up from time to time. That just doesn't happen to this degree in Wall Street proper. So I think if you want to play at crypto, you can. If you want to win at crypto, you can. But my opinion is just do what big money does. Let's look at finally at two ways I think it can be done. And these, not coincidentally, are services that we offer. We run crypto analysis in two ways, and you can find this in our Inner Circle service, which if you remember, or you can also subscribe to it separately in our Big Money Crypto service if you're not an Inner Circle member. Two ways to do it, in my opinion: with technical analysis, with quantitative analysis. Let's deal with quantitative first. Okay, so we run an algorithmic service that looks at these 5 names every single trading day, and it prints a signal every day before the New York Open. Obviously, crypto trades 24/7, but we have a sort of a marker of the New York Open for these. Super simple output. It considers various factors that you could sum up really as sort of price and momentum, really, but not momentum as MACD and RSI and those things, just a custom blend of momentum. And this model thinks about it. It thinks, well, do I think that this is a risk on or a risk off day ahead? And if I think it's a risk on day, risk on means the model thinks that that particular asset should be held. I'll print a 1, which means I think buy, or if you already buy, hold. And if I think it's a risk off day, something bad might happen, I'll print a 0. And a 0 just means either do nothing if you don't own it, or sell if you do. And of course, you don't have to follow these models to dot accuracy every day, but I can tell you that it works pretty well. And for instance, this was the print on Friday morning before all the trouble. So our crypto signals printed risk off in Bitcoin, risk off in Ether, risk off in Solana. And so had you acted, and they were, as you can see, previously Ether had been off the day before, Bitcoin had been on, Solana had been on the day before. And had you acted on that, you'd avoided an awful lot of trouble. We deliver that service in a very, very, very simple print each morning, and there's a discussion channel as well. We also provide extensive technical analysis. Now, technical analysis is a big word. If you're not familiar with it, it just means measuring price and volume and trying to make judgments about where price will go based on where price has been. And I'm just going to show you this chart, which again for Ether, it works for all these things, but I'll show you for Ether. Just get this on your screen right now. Okay, so there's a lot of lines on here, but let me explain. This is the important point here. This is the low that was struck after the Liberation Day sell-off. This is the 9th of April lows. And the lines on here, this blue purple line here, this is the 200-day simple moving average. Blue line is the 50-day simple moving average. Green line, 21-day exponential moving average. Red line, 8-day simple moving average. And then we have an overlay of, again, these Elliott waves and these ladders here are the Fibonacci levels. So what I can tell you, if this is unfamiliar to you, is this, again, this is a Wall Street pattern. This is a big money pattern. So what do we see here? We see the Liberation Day lows down here at 1385. We see a wave one up, sells down to only a 0.5 retrace. That's a really bullish drop, right? As in it's not much of a drop. We then get strong wave three up, which peaks up at 24th of August, and it peaks at just shy of 5,000, almost a 200% extension, meaning the price movement from here to here was almost 2x the price movement from here to here. And then it starts to sell off. Now, this whole time, it's hovering over this green 21-day moving average. When it loses it, it really drops hard, which is common. Again, that's a Wall Street pattern. Regains it here, drops back down through it, closed below it on Thursday. That was a tell. On Thursday, Ether closed below the 8-day, below the 21-day, and below the 50-day. That was a tell. So if you were in our Inner Circle service, we pointed this out. And then, of course, here's the big drop on Friday. Trades over the weekends, we know, down a bit more on Saturday, up strongly on Sunday, up a little bit today. But if we zoom in, look, this is not out of the woods yet. So Ether closes just underneath the 8-day and the 21-day and already under the 50. What that tells you is that Ether is not out of the woods yet. If you were thinking about buying a long Ether position, could, of course, but a lower risk thing to do would be just to wait, see if it gets over, in particular that green line, the 21-day exponential moving average, enter a long position with a stop a little bit below to keep you safe if it sells off. And in this cycle, I'm not saying forever, but in this move up from the April lows, a likely target here is somewhere between 5,300 and 6,300, which it should hit in the next, I'm going to say 2-3 months, if Friday's low remains. And if Friday's low is revisited and drops below, then we have to drag this scale down and drag down our price target. But again, this is, you see this kind of pattern play out time and again in all of the big liquid stocks. So again, this tells you that this is a big money game. So in summary, I think the dream of crypto, to the extent that it ever was real, I doubt that, to be honest, but let's say it was ever real, and let's say it survived so far. I think it died on Friday. And I think crypto is a great way to make money still. But I think the way to do it is by donning a set of Wall Street clothes and doing it through ETFs. That keeps you safe from exchange risk and crypto exchange risk. And also playing according to simple price patterns as opposed to, influencers, podcasts, all of that. Just watch price and watch volume and trade it like you would any equity. Okay. End of crypto section. I'm going to pause for a minute, and if we have any questions, points, comments, or anything else, now's a great time before we move on, and we'll talk about equity indices and beyond. So anything else, and go ahead. Paloma, how you doing?
Hello, Alex.
Hey, how are you?
Hi, how are you? Um, I just have a question with the Siemens signals. Okay,
Yeah,
if it says like it said on the 9th of October, risk off, does that mean
yeah.
that you just sell your whole position in Bitcoin and in Ethereum, or you sell half of it, or I mean, what is the
Yeah.
the risk off?
Well, the way the
Uh,
the way the model works, okay, and of course we're all different, but the way the model works is the model set. Remember, the model is just a machine. It doesn't know about emotions. It doesn't know about tax. Okay, so what the model does is it goes, I think a bad day is coming up, 0. So what the model does, if you gave your money to the model to run, the model will go, I'm selling everything, I'm out, right? And then the next day, if it flipped to 1, the model would go, I'll buy all. And what the model would do is say, okay, well, I sold X dollars of Bitcoin, um, Y dollars of Ether on date X. It then flips long, say 2 days later, risk on 2 days later, and it would take the same amount of dollars and whatever the price per dollar of Bitcoin and Ether was, it would reapply that same amount of dollars then. So it would just go sell it all, wait, buy it all. Now, as you know, we run a number of services like that across crypto and equities. And so if I look across the user base of those things, people use them differently. But me personally, um, when I use these services, I use them uh, religiously and according to service definition, because I try to take all my own judgment out of it. My decision is, I've worked with the authors of these algorithms to figure out, how these things should run, and I understand how they're built. So I didn't write them myself, but I'm very close to how they work, and so my faith in those algos is pretty strong. And therefore, when I use them, I just trade according to them. So we have as you know, an ETF rotation signal service like this, and whatever it says to do, that happens to print at the close. I just do it. Like, I don't even question it. I just do it. Why? Because it's been successful so far, as of Siemens crypto signals here, and it takes all of the angst out of the decision. You don't have to sit there and wonder about what's going to happen tomorrow or this, that, and the other, because the model is back tested and fitted on long-lived prior data, and the model is going to be wrong from time to time. But overall, these models have proven pretty good in back testing in live trading. So yeah, by design, you would do exactly as the model says. Now, not everyone does that. So what some subscribers do is they go, well, okay, I'm a bit worried. Oh, and the model has also flipped risk off. Okay, well, I'll hedge, or I'll sell some, or I'll sell everything, but they'll apply some judgment to it. Everyone's different, but it's there. I think if it's a robot buddy, right? You've got your ice cold robot going, this is what I think, and of course you can react, you can trade accordingly.
Of course. And for example, in this case, you have sold all your Ethereum position?
I did not know. I don't trade. I personally don't trade on this set of signals. I trade according to my own charts on Ether, but I do trade our signals in ETF rotation, for instance, and then our rotation ETF signals on Friday said, from recall, get out of SMH, get out of XLK, which I did, and I did completely. And it said just hold GDX, which is in there already, so I did. So I didn't even think about it. I just do it. I don't trade this. I trade my own charts in crypto. But if I followed this model, I would do exactly what the model says. Yep.
Yeah. So you are still long Ether, right?
I am. I'm long ETHA.
Yeah. Okay. In my case, I buy the underlier directly. So I own
Mm-hmm.
Ethereum and Bitcoin, not the ETFs. I buy it through a platform, and then I put it into a ledger, so it won't disappear.
Yep.
And my question is, well, it was incredible because I don't know. Friday night I was bored and I was looking. I said I'm gonna check the screens. Yeah, because there was no good movie on the television. So,
There's a great movie on a different screen though.
but I'm in Madrid now, so there was no movie, and I said, oh, I'm just gonna take a quick look at the close, and then suddenly I see this
I'm,
catastrophe,
I'm,
and I'm like, what the
what
f
the
you
hell's that? I
say?
know. Yeah.
is going on, and then I read about the news about Trump and China, and Ethereum was down 20% at that
I know,
point,
I know, I know, I know.
and I bought it.
Yeah, well done, right? Well,
I got it at
Ether closed. That's
3,700, but
that's
I
that's
was
brilliant.
really I was really
That
scared because I
no
thought
no
it
no
would
that's
go further down.
that's brilliant. No, that's brilliant. I missed it, to be honest. So I sat there. I was really pleased because I've been hedged all day in equities, and then at the close, I went right. Add to the longs, right? Because obviously the short had drifted up and the longs down. I thought, great, right. Add to the longs, rehedge, go 1-to-1 in equities, and I was absolutely delighted. A really good day. And I thought, okay, I think it's going to go up Monday, so I'm done. Brilliant. And then I was sort of doing something else, making a cup of coffee. I was like, what the hell is going on? What's that number in my account? Okay, what's that?
Yeah,
Crypto.
yeah,
Okay,
yeah,
and I didn't react quickly enough. So well done, you. Brilliant. Absolutely brilliant.
yeah. So, but my question is, yeah, it was just a coincidence. If there was a good movie, I would have never bought Ether. So, I'm very happy. But I heard you say that you could see some weakness, in the short term for Ethereum.
Yeah, just because it closed. I mean, SPY did this today. I mean, it's almost a joke, right? So Ether closed to the cent at the 21-day EMA and the 8-day SMA, just I think just below or just at. So that is on a chart. That's not a very clear signal. So my decision on that personally is just hold. I think, and if I just put this chart back up on here, hold on a second. Here we go. I think this is a way 5 up, but then I thought it's up here as well. So we'll see. If I had no position in Ether, I wouldn't buy here. I'd wait for it to be over the green, over the 21-day green line. But I do have a position, and I think this is going to trend up. And if you notice, the Tom Lee vehicle, Bitmine Immersion, was buying hand over fist all weekend, as much as they could scoop up. So I'm still bullish on Ether. I think this will be fine, but the closing price is, almost by design a bit unclear. And so if we see any weakness tomorrow, it wouldn't surprise me. But my opinion is this is going to make it up to 5,300, 6,300, somewhere in that range is my guess. But that's just a guess.
In terms of asset allocation, I mean, I just did 50%, 50% because it was like easier for me to follow. So 50% in Bitcoin and 50% in Ether. But which is doing better of the two? Because I haven't been following it.
I personally think, well, it's just an opinion, but if you want my view on forward movement, I think Ether has more utility, and I don't know what it is that Peter Thiel is up to, but Peter Thiel via Bitmine Immersion and via FZilla buying quite a lot of Ether, and so on the principle of no one got poor following Peter Thiel around, I got significantly bigger exposure to Ether than I do Bitcoin by a factor of 3.5 to 1, something like that. So that's just my view.
Okay.
All right. It's great, Paloma. Thank you, and well done. Congratulations. Really great. I'm sure you'll profit nicely from that. Yeah. Okay, folks. Anyone else before we move on? Dave, you're on.
Alex, just looking at your chart here, you've got I see there's kind of a golden cross around June, July, and obviously you've got the Fibonacci's and the 8 waves. How much weight do you give to the moving averages versus the other signals?
Well, moving average is a fact, and the rest of it is an opinion. So you have to short term, I think, respect whether a moving average, particularly the 21-day EMA, is holding or not. So a break to the downside of the 21, that's a material bearish signal. So in the S&P, for instance, if you only ever owned it above the 21-day EMA, then that massively outperforms buy and hold. And probably the same is true here. Wave projections, as you know, are just projections. They're just opinion,
Yeah.
or they're retrofitted patterns. So they're useful guides, a bit like a map, but they're not definite. Whereas the moving averages, they are historical price facts. So my own view is I look at the following, right? The wave guide looking forward is sort of interesting, but it's an opinion. They're conjured up in the mind of the chart creator. So, they can reflect, did you have a good breakfast that day or not? Another, random nonsense. The Fibonacci levels for, when actual price pivots happened, they're facts, and they're reasonably useful as predictors. The volume by price analysis is a fact. Hang on, switch it on here. So you have to use some judgments about, is it largely grown-up buying or grown-up selling, and is it idiots buying or selling? You can't know that from this volume. You have to make some judgments. But broadly, it's probably not idiots buying down here. It's probably grown-ups, and it's probably not grown-ups buying up here. It's probably idiots, right? So this is also a factual overlay. So on a day-to-day basis, my own view is you trust the moving averages. If you're looking to make some projections over the next few days, weeks, months, and work at your allocations accordingly, then it's a combination of waveguide, the volume print by price that tells you some, where the weight of buying is happening, and the fib levels. That's a very long answer, sorry.
No, that's good. That's great. Thank you very much.
Welcome. Anyone else, folks, before we move on? Okay, well, in that case, we're going to move off of crypto and we're going to move on to regular equities. So let's get world's most boring chart on the screen here. So this is the longer term chart we use on SPY. Again, this is the COVID low here. Wave 1 up, 2 down, 50% retracing to the 2022 bear market lows, and we're on course, I think, for at least a 1.618 extension in the SPY, which would take it up to about 770, and of course, maybe higher. I think that the temporary pause in October, if you look, so far it looks like October is a nothing burger from open to today's close. I think that's temporary respite. I think we're going to power through it. Can anyone who's not on mute go on mute, please? I think we're going to power through this. You have accommodative monetary policy in the US, fiscal stimulus in place and coming. You have an administration that's committed to driving down the cost of money in the guise of the 10-year yield and the Fed funds rate. And you also have an administration which very definitely uses equity prices as a measure of success, and you have the midterms coming up. So I think that longer term, by which I mean the next certainly a few months, maybe a year or so, I think we've got plenty of upside in the S&P on that time frame. We dive in a bit. The shorter term chart is really interesting, and I think it's a great chart to look at this because it is great evidence, in my opinion, that the sell-off Friday, of course, everyone will tie to presidential tweet and all of that, but actually, this was getting ready to happen anyway. So let's just have a look at SPY with the moving averages, and let's look at what price action was doing in the run up to Friday, right? So here's last Tuesday, Wednesday, Thursday, Friday. Now look, in fact, if you go right back to last Friday, the 3rd, you can see that SPY can't really break over this sort of 674 price. And I mean, I've said it, a million times, and I said it in Friday's market on Open Note, which is if you can't get up and over a particular price, and it's really tried over a number of days, well, that's resistance. I mean, by definition, it's resistance, and you're going to get a correction. So you don't always get a corrective move that big, but that's all it was, a correction. And if you look at what SPY did, it was ready to go anyway. It probably would have sold off Friday, regardless of tweet. It probably would have got down to the 8, maybe down to the 21. As it happened, it went down to the 50 because of a whole bunch of panicked reactions. And we got support over the 50-day moving average, and so far a gap up and a bounce. We'll see where this goes in the next few days. It's quite common in these sorts of sell-offs, as you know, if you're a member here, it's quite common to get these sorts of A, B, C corrections. So I wouldn't be at all surprised if today was a sort of a fake out to make people think everyone's fine and sucks the money before another smack down here. If we get this, I don't think it's any kind of bear market. Wouldn't be at all surprised if it just retested this 50-day moving average. But a red day tomorrow, if that happens, I don't think that signals, a turn of the bull into the bear. I think it just signals let's mess with people's heads for a bit longer and try to pick up some cheap shares before a Q4 rally is how I would see it. So this today's close, intraday, it was well over the 21-day moving average. This close was right at it, deliberately confusing in my opinion. So thank you, big money, for that. So I think probably trending up over the course of the next few weeks and months, but the next 2 days might be a bit tricky, so we shall see. If we look at the NASDAQ, again, longer term, this is a weekly chart, again, going back to the COVID lows. And nothing about this chart suggests to me that QQQ isn't going to get to 650 and maybe beyond. So that's 8-9% up from here, and I suspect beyond that, to be honest. But I do not think Friday was any sort of material top. I think it was just a hiccup along the way. And again, if we look short term, the Nasdaq's actually in a much more bullish position than the S&P. So this is QQQ. And remember the thing I just said about SPY, it closed at the 21-day, having been over it for some of the day. Well, look, QQQ was over the 21-day pretty much all day. So it opened here, it peaked up here, it dropped down here to intraday, toyed with the 21-day, bounced, moved up, closed here. So that's a much more bullish look than the SPY. Buoyed, of course, by the OpenAI announcement of their deal with Broadcom, semiconductor sector on fire again. So that's a more bullish look for the QQQ, and that in turn is sort of bullish for SPY because there's so much overlap, as you know, between the two indices that it's unusual to see the Nasdaq going up and the S&P going down. It does happen, but not often. The Dow, interestingly, which is very often a leading indicator. So, for instance, this is the DIA. So this is last Friday in the Dow. Monday, Tuesday, Wednesday, Thursday, red days, Friday, deep red day. Very, very often the Dow will tell you a little bit ahead of time what the S&P and the Dow are going to do. S&P and the Nasdaq are going to do. I'm sorry. Why that is, I don't know. But it happens more often again than is coincidental. So if you see the S&P and the Nasdaq in good shape, or even more so in hitting a heads-on resistance, but you see the Dow falling, get ready for a drop-off in the S&P and the Nasdaq. It certainly happened this week. Now the Dow did not have a particularly bullish close in my view, somewhere between the 21-day, way below the 8, which is now pointing down, okay, above the 50. That's not a bullish close. That's a weak close. For the Dow to move up tomorrow, you'd want that up and over the 21. And so I think the evidence is mixed as to where the short-term move is. So me personally, right now, and I might change this later on, but right now I remain pretty much one-to-one hedge long short in the Nasdaq, for instance, and also in semiconductor, because I just want to see where things go over the next day or two. Let's also just look at semiconductor before we finish up and take some more questions. So semiconductor, as you know, is leading the charge right now. This is SOXX. And again, look, anyone who's going to tell you that the market tanked because of the Trump tweet, I mean, it's clearly incorrect. It might have been the catalyst for a bigger than normal sell-off, but the notion that the market was in great shape otherwise is just wrong. Look, here's SOXX on Monday, can't get up and over 292. Tuesday, the same. Wednesday, huge green day on Wednesday, bounces off the 8-day moving average, but can't break that high. Thursday, can't break the high. Friday starts there and dumps. So Friday was just a culmination of a really weak few days. So what happened in SOXX? Dumped on Friday, sort of bounced, sort of at the 21-day, a bit below, and then today That's a bullish close in semiconductors today, and that's a bullish sign for the Nasdaq. It's a bullish sign for the S&P. So here it gapped up and it opened above 21-day, and it never went near it during the day, and it closed up and above the 8-day. So this is the most bullish of the charts we've just looked at. Semiconductor has led the market from the April lows this year, and so this is the most bullish indicator of a possible move up in the S&P and the Nasdaq short term. Okay, we've got a few minutes left. Any more questions, comments, points, anything at all? So again, we have a written question here. Peter Quick, can we look at IGV? We can, Peter, although I haven't looked at it in ages, so I don't know how up to date the chart will be. 1 second. Okay, so this is software. That's in surprisingly good shape given what a mess software is. Okay, hold on. Okay, bear with me 1 second. I'm surprised how strong that is, to be honest. Okay, so if I had to guess, I would say yeah, okay, just a guess. I don't follow this one, so I'm sort of making this up as I go along. So I'm going to say that's a 3, that's a 4. Okay, if you own this, you got to watch this, because that would be a shallow wave 5. It could well be a 5, particularly what's happening in software. Software is in a tough spot. You got to watch this, I think. So, okay, simple test. If it makes a new high up and over that wave 5 high, up and over 118, then you've probably got a good way longer to go. If it can't break 118, then I think you're going to see you know, a deeper correction. I think you need to watch. I think you need to watch enterprise software at the moment. I've said this for a long time, but anything that's reliant one way or the other on user seats, human seats as a driver of revenue, has got some problems with, you know, layoffs, AI deflation, and also the companies themselves, the enterprise software companies themselves, have got some problems with their own cost bases and a number of manual coders they have. And I feel like a change is due in enterprise software. It's been 21 years since the Salesforce IPO, and cloud has been dominant for that time. So I'd just be a bit careful with this one personally. As always, I'd let price determine it, not opinion. But this is a bearish, you know, forward look here. That would invalidate if you got up and over that prior wave 5, I think. Michael, Rigetti, no. I mean, you know, it's a meme stock at this point. I'm short it actually with a very, very long dated small put position. It's not a real company, it's a plaything, and the stock will go up for as long as they can find buyers, and then it will stop. So that's my simple view on Rigetti. I mean, we can look at the chart, but it's, hang on. I mean, you know, that can keep going up for a very long time, and then it can fall. So I'm short from about here-ish, with long dated put size for 0, as in I assume I'm going to lose all the money, but I can't lose more than the premium paid. That's why I'm not just short the equity. If you short the equity, your max loss is infinite. Obviously, if you're short via a long put, your max loss is what you pay it. So, you know, it's a low risk bet for me. It's a small allocation. But I mean, there's no reality to the company. there is an awful lot of meme stock trading of quantum names in South Korea right now. It's true for Rigetti, it's true for IonQ. So that's a great game that will keep going up for as long as they keep it going up, and then it won't. So when that changes, your guess is as good as mine. Richard, you're on.
Thanks, Alex. Could you just have a look at that IGV chart, but from a longer term perspective? Because what I'm finding is it's actually really interesting to compare how the short-term chart fits into the longer-term chart. So for me, IGV is I'm more optimistic because the long-term chart shows that the wave 3 still has a ways to go.
Yeah.
Potentially.
Yeah. I buy that. Yeah, I buy that. So your argument would be, well, look, we haven't even hit. We're only at 1.236 right now, a bit above it. And
so I'm literally looking on the charts right now, and I was just doing that IGV chart, in fact, just a little while back, and I show exactly like you said, we're on a wave 5, but my interpretation would be because the larger degree wave 3, would be otherwise quite shallow. I think the wave 5 may have a little bit longer to go.
I think it's a good argument. Yeah, I think it's a good argument. And so I mean, if you said I think it can hit 135, we come 114, then yeah, I could see that. Yeah, it's a good point. Very good point. So Richard's point is always zoom out on short-term charts, right? So then you can avoid getting lost in the weeds a bit if you take a longer-term view. So yeah, I would agree.
Yeah, definitely. And then the other one is on SOXX. Do you again feel, should we be thinking of ABC? How likely in your experience is it that, this huge drop of Friday, we kind of recover half the drop today, and we would expect to just now go straight up from here? How likely do you think that is, as opposed to, the retrace maybe has started and we've kind of, went part of the way there Friday, a little bit back up today, maybe again carrying on tomorrow? What's your thought in terms of probabilities, at least?
Yeah, I mean, the trouble is semiconductor, as you know, this is driven by press release right now. So, stock price reaction in Broadcom, AMD, was it last week? It's driven, it's OpenAI quantitative easing. It's press release go burr. And so, Broadcom was up, I think, 10% at one point today.
Yeah,
closed just under 10% up. Why? Because collaboration with OpenAI and yet another probably non-committal financial obligation from OpenAI that says we might buy some chips off you at some point in the future. And so you've got this incredible bullishness in semiconductor, which is it's obviously purely, sentiment's the wrong word, but it's driven by this sort of jam tomorrow AI build out promise. And it's hard to, the whole sector is trading in a not quite meme coinish way, but a bit that way. And so the only mistake that anyone has made in semiconductor since April is to be at all cautious. So if you look at that chart, what is it that should happen? Yeah, there should be a drop here, right? So that 292 does look like a wave 3 high. It's almost a 3.618 extension. It spent 5 days not getting through that level. A big drop here. Okay, relief rally today. What should happen? I mean, you would expect it to drop to at least 260-ish, something like that. That 23.6 retrace and hold at 50, and then a move up, and maybe deeper. I do think it's going higher from here, but if you weren't getting these crazy, non-binding promises from an underfunded customer, then you wouldn't be seeing it up here already. And so it's a really tough one. That pattern, those 5 days, that's resistance. That's hard resistance. If we look at volume by price, what is this? That's not distribution. That's probably, regretful late buyers here. That distribution up there is not much volume. It's really hard to say. My own view, as you see my trades is I keep the hedging on in semiconductor, and I keep taking profits on the way up on the long leg, because at some point this kind of has to correct. But so far, it's just been more bullish than certainly I would have expected to be. So that's been fine. I made money on the long side with one foot on the brake on the short side, but it just continues to be more resilient than I would think. That bugs me. Those 5 days that can't get over a 3.618 extension, that nags at me. So if that 292 is not taken out, if that continues to act as resistance, you've got to believe you're going to see a correction. You would think. But then I've bet for you for some months, so who knows?
Great, thanks.
All right. Okay, folks, we're pretty much done for time. Thanks to everybody for joining today. If you're an Inner Circle member, thanks as always for being part of the service. If you're new here, thanks for taking the time to join. I hope you found something useful in the session. I'll post a recording on our Slack system for Inner Circle members, and it'll be on X later on today as well. If you're not an Inner Circle member and you want to be, you can find it on our website. And again, if it's crypto coverage you're interested in and just crypto coverage, have a look at our Big Money Crypto service, which covers both written newsletters, technical analysis, and also quant signals. And you can buy the signals with or without the newsletter. Thanks, everyone. Talk to you all soon.